At this point, we've covered both the income statement and balance sheet, along with the connection between the two. And we learned that the primary connection is the flow from net income on the income statement into retained earnings on the balance sheet. So with those two reports, we were able to answer one question about owner's equity, namely, how did our current year earnings, or lack of earnings, affect the owner's stake in the business? But as we touched on at the end of the last episode, that did leave some questions unanswered about other changes to the owner's share of the business. Why did our common stock increase? Where did our retained earnings from the prior year go? Well, in this episode, we'll answer all of those by looking at the third of the four primary financial statements, the statement of stockholders' equity. Now, for most businesses, this will be the simplest of the four statements. It really has one job. While the balance sheet tells us where the owner's equity stands at a point in time, the statement of equity is there to tell us how the balance sheet ended where it did. So in all cases, the statement of equity will begin with the balances within the owner's equity accounts at the beginning of a period, then show us where the changes occurred throughout the period, and arrive at the ending balances shown on the balance sheet. So let's see that play out in the context of Brightleaf. If we look at the balance sheet quickly, we know that owner's equity at the beginning of 2026 totaled $457,500, made up of $400,000 invested through common stock and $57,500 in earnings during 2025. And at the end of the year, the total grew to $580,820, made up of $450,000 invested through common stock and $130,820 in accumulated earnings. And if we now look at the statement of owner's equity for Brightleaf in 2026, you'll see those exact amounts. Across the top, each column represents an account within owner's equity on the balance sheet, with the total listed at the far right. And then the top row shows the beginning amounts in 2026 for each account, which will match the balance sheet amounts as of December 31st, 2025. And sure enough, if we put them up side by side, you can see they do. Then we have a list of all the things that caused owner's equity to change during the year. So the first thing we can see is that the additional $50,000 in common stock was due to shares issued to owners, maybe either the existing ones putting in new capital or new owners joining the business. If the business had instead purchased a piece of equipment with stock or maybe even paid employees in stock, you'd see a different description, something like acquisition of equipment with common stock or employee stock compensation or something like that. But in Brightleaf's case, it was simply a further cash investment in exchange for additional ownership. Now there is one more interesting thing we can learn about common stock here, and that's the number of shares outstanding. You could see that at the beginning of the year, the common stock of $400,000 represented 40,000 shares outstanding. So to that point, Brightleaf had issued each share of stock for an average of $10. But for the stock issued during 2026, it required $12.50 to purchase one new share. So the owners had determined that the market value of the company had grown a bit and required any new owners to pay a bit more than previous ones. Because of that, the number of shares outstanding at the end of the year totaled 44,000, which represents an average of $10.23 per share issued. Then the next line after shares issued for common stock clears up our question about what happened to our retained earnings during the year. You could see Brightleaf paid out $25,000 in dividends to its owners. Now again, I don't want to dive too deep into accounting topics, but dividends end up reducing retained earnings for a business for the simple reason that those earnings have been paid out and are no longer retained. So after a dividend has been declared, we end up recording that as a reduction to retained earnings. Then finally, owner's equity grew by $98,320 during the year thanks to the net income the company earned. And if we look back at our income statement quickly, sure enough, that matches precisely the net income we calculated there. So while the statement of equity is primarily connected to the balance sheet, in that its job is to provide the detail of why the owner's equity on the balance sheet changed, It also connects here to the income statement, as the net income earned will always flow to the owner's equity on the balance sheet and change our retained earnings. And that change is reflected in one of the lines here. So that's Brightleaf's statement of owner's equity. Now before we go, I do want to call back to one item we touched on briefly all the way back in our first episode. Recall that I mentioned at the time that the income statement is actually part of a larger statement called the Statement of Comprehensive Income. And the Statement of Comprehensive Income can include things in addition to the items that make up net income. These are generally pretty specific items, things like currency translation adjustments for foreign subsidiaries, unrealized changes in the value of cash flow hedges, changes in pension obligations, things like that. And those items will flow directly to a line item within owner's equity on the balance sheet called Accumulated Other Comprehensive Income or Loss. Now, Brightleaf's business is simple enough to not have any of these items, but if we turn back to PepsiCo briefly, you can see here in their most recent 10K, they have their statement of income and below that statement of comprehensive income. And here they have some of those items we discussed: currency translation, changes in cash flow hedges, pension adjustments, and net changes in the value of available for sale debt securities. And in total, those items represent a change in accumulated other comprehensive income of $2,588 million. This business is just a bit larger than Brightleaf. So if we then look at their statement of owner's equity, you'll see they organize it a bit differently, with time across the top and the accounts down the side. I actually don't like this presentation as much as time shown vertically and accounts horizontally, but PepsiCo does have more accounts to organize, and who am I to tell them how to present their statements? So while much larger than Brightleaf, you could see a lot of the same things. Here their common stock and capital in excess of par value increased, though not due to additional sales like Brightleaf, but instead from paying employees in stock and some activity with restricted stock units. And then their retained earnings changed due to the net income attributable to PepsiCo on their income statement. And just like Brightleaf, their retained earnings were reduced a bit by dividends. And then you can see that accumulated other comprehensive loss here. And the accumulated loss was reduced by $2,588 million, exactly what we saw on their statement of comprehensive income. And sure enough, if we just look at their balance sheet quickly, you can see their accumulated other comprehensive loss went from $17,612 million at the beginning of the year to $15,024 million at the end of the year, a change of $2,588 million. So that sheds some light on the statement of comprehensive income, where all those changes in those items accumulate here on the balance sheet in accumulated other comprehensive income, or in Pepsi's case, accumulated other comprehensive loss. And that's our entire discussion on the statement of owner's equity. It's simply the roll forward that tells the story that the point-in-time snapshots on the balance sheet cannot. In Brightleaf's case, we learned that the changes were due to issuance of stock at an amount a bit above previous issuances, a $25,000 dividend payment to owners, and the $98,320 in net income that we saw all the way back when covering the income statement. Now speaking of net income, we earned $98,320 of profit during 2026. But if we look at the balance sheet, you can see our cash actually rose from $15,760 at the beginning of the year to $159,163 at the end, a change of $143,403. So how did our cash balance go up by more than our profit? Well, that's a good question. And while we could discern a lot of what happened by painstakingly going through every balance sheet item and looking at the changes, the good news is we don't need to, because there is a fourth and final financial statement designed to answer that very question, the statement of cash flows. And we'll cover that in the next episode.